Welcome to the Volume Spread Analysis course. In this course, you will learn the concept of volume spread analysis in a simple and effective manner, and then you will be able to start using this technique in your trades right away. If you are new to the channel, please consider subscribing right now and leaving your like to support the ongoing creation of free videos like this one. Volume spread analysis is a rather simple technique, but it's a powerful one. It's mainly used to know the strength behind a candle and to confirm the strength of a support or resistance level. There are many times when a trader sees price reaching a barrier in the chart, like some sort of line for example, but the trader is not sure about the strength of this barrier, meaning if the barrier will indeed hold price. Volume spread analysis can be of tremendous help in situations like this. VSA can also be used in combination with other modes of analysis that measure the strength behind price movement, like velocity and other types of volume tools. Volume spread analysis, or VSA, is simply the comparison between candle range and the corresponding volume action. The candle range can have two main forms. Candles can be narrow, like we can see in this illustration, or they can be wide, as we can see in this other illustration. Volume action, which is analyzed in the simple volume histogram in this case, also has two main forms. There is low volume and high volume. This classification of narrow, wide, low, and high depends on the context of what's happening around the candle being analyzed. This gives rise to four possible scenarios that have distinct interpretations. We have wide range candles with high volume, wide range candles with low volume, narrow range candles with high volume, and narrow range candles with low volume. Knowing the interpretation of these four scenarios is critical. It's sometimes the difference between entering a trade or not, or the difference between proving or disproving a price barrier. To understand VSA, we need to recall a few other ideas from other types of analysis. Remember the most important rule about volume stated a long time ago in the Dow theory, which is that volume confirms price action. That basically means that wide price movements require a lot of volume in normal circumstances, and narrow price movements require low volume. When a wide price movement has low volume or a narrow price movement has high volume, something different is happening in the market, so it's worth paying closer attention to it. The other very important notions we need to truly understand VSA are liquidity depth and supply and demand. In each price level, there is a certain number of buy orders and a certain level of sell orders. It's useful to observe how that works in the order book. The order book has three columns. On the left, we have the bid column, which represents buy orders or demand. In the middle column, we have price, and on the right, we have the ask column, which represents sell orders or supply. For price to rise, buyers must buy an amount that corresponds to the total number of sell orders in the current level. For example, now in this hypothetical order book, price is at $50, and there are 63 sell orders at this level. For price to rise to $51, buyers must attack the supply of 63 sell orders, and then there will be no supply left at this level, making price rise to the next price level of $51, which has 76 sell orders. For price to rise from $51 to $52, buyers must attack the supply of 76 sell orders first. The same logic works on the way down, of course. For price to go down, sellers must attack demand on the way down. The important point here is that the higher the number of orders, the higher the volume. Here's one important detail. Notice that when liquidity is shallow, meaning a small number of orders at each price level, it's easy to attack this liquidity. For example, if there is shallow liquidity across the ask column, it's easy for buyers to attack the supply. That means that shallow liquidity creates wide price movements with low volume. If liquidity is deep, meaning a large number of orders, it's difficult to attack this liquidity. For example, if there is deep liquidity across the ask column, it's difficult for buyers to attack the supply. That means that deep liquidity creates narrow price movements with high volume. Liquidity depth is what creates the different scenarios outlined in volume spread analysis. Let's begin with the most intuitive of all examples, which is when we see a wide range candle supported by high volume. This is also called a high volume continuation candle. There is a decent level of supply and a decent level of demand, but in the case of a bullish continuation candle, there is more demand than supply, and in the case of a bearish continuation candle, there is more supply than demand. The main point here is that supply and demand are neither shallow nor deep. Buyers and sellers have interest, but one side of the market ends up having more interest than the other. In other words, as the name clearly suggests, the high volume continuation candle implies that there is going to be a continuation in the direction of the candle. Let's observe a hypothetical situation of the high volume continuation candle. In this illustration, we see a high volume wide range candle approaching a resistance level. The first thing that comes to mind for any trader is whether this resistance will hold price. A high volume wide range candle, also known as the high volume continuation candle, implies that price will continue going in the direction of the candle. So in this case, the resistance will now be strong enough to hold price. Obviously, that's not the only factor at play here. There might be other elements influencing how strong the resistance is, but in terms of volume spread analysis, this type of candle is bound to break the resistance. The same logic applies for bearish high volume continuation candles approaching support levels, of course. Let's move on now to the case where we see a wide range candle with low volume. This is also called a low volume reversal candle. Low volume in a wide range candle means that it was very easy for one of the sides to attack the other. This also means that there is a lack of interest from one of the sides. Another way of seeing this is that there is a shallow liquidity across a wide price range. In a wide range bullish candle with low volume, there is the lack of interest from sellers. In a wide range bearish candle with low volume, there is the lack of interest from buyers. When there is the lack of interest from buyers, for example, it's very easy for sellers to attack the demand and make price go down, and that results in a large price movement with low volume. A wide range candle with low volume is often called a low volume reversal candle because the wide range candle will usually stop when there is a deeper liquidity pool that may indicate a reversal. Not to mention the fact that the market participant in control of the candle will exhaust its power through the course of the candle. Let's quickly observe a hypothetical scenario of the low volume reversal candle. In this illustration, we see price approaching a resistance level with wide range and low volume. The low volume implies that there is lack of interest from sellers in this case, but only up to the point where there is a significant barrier or a deeper liquidity pool, which is what would happen in a resistance line. So if a wide range candle with low volume stops at a resistance line like this, it might indicate that sellers will assume control of the market from this point forward. These are the two scenarios for wide range candles. Now we can explore the two scenarios for narrow range candles. Let's start with the narrow range low volume candle, which is easier to understand. Low volume is what traders expect in a narrow range candle since there is not a lot of price movement. This is sometimes called a low volume rest candle. It simply means that the market has taken a break from advancing. Let's observe a hypothetical situation. Imagine that price is approaching a resistance line, and at that line, a low volume rest candle appears. Without a resistance line, the rest candle could also mean a continuation to the upside, but in this case, the resistance will indicate a reversal. The reason for that is that the resistance is probably stronger than the low volume rest candle. In other words, the resistance is enough to nudge price in the other direction in a situation like this. The other scenario, which is a little more interesting, is when there is a narrow range candle with high volume. High volume is only expected in a wide range candle, so when it happens in a narrow range candle, we know there is something going on in the market. High volume occurring in a narrow price range means that one side of the market is aggressively attacking the other, and the side being attacked is successfully absorbing the attack. That results in a high level of activity or volume in a narrow price range. This narrow range candle with high volume is often called high volume reversal candle. In summary, one side is trying to advance the market and the other is being successful at not letting that happen. In an uptrend, a narrow range candle with suspiciously high volume is a sell signal. It means that buyers are aggressively trying to make prices rise, but sellers are absorbing all this demand successfully, resulting in a narrow range with very high activity. In a downtrend, a narrow range candle with high volume is a buy signal. It means that sellers are aggressively trying to make prices fall, but buyers are successfully absorbing the supply. In other words, a high volume reversal candle is an indication that there is a barrier in price created by supply or demand. Let's bring this idea to a hypothetical scenario once again. Imagine that price is approaching a resistance line, and at the resistance line, we see a high volume narrow range candle. That is a clear indication that buyers are trying to push the market higher, but the sellers at that resistance level are successfully absorbing the demand, which is a sell signal. This is why this type of candle formation is called high volume reversal candle. It implies a barrier strong enough to nudge price in the other direction. One of the problems of volume spread analysis is, of course, the relative nature of the approach, meaning that we need some sort of benchmark to define what is wide or narrow range and what is low or high volume. As I stated previously, this sort of thing depends on the market context. To truly understand how that works, we need some real-world scenarios. Look at this chart carefully. We have a support defined by an important low in price action. So far, there's nothing different. Right here, we see price landing at the support exactly with a wide range candle. We know this is a wide range candle when we compare it with the other candles around it. This same exact candle could be considered as a medium-sized candle in other scenarios. Here's the tricky part. When we look at the corresponding volume of this wide range candle, we might be tempted to assume that it has high volume. But that comes from the absolute perception of volume. If we compare it with other bearish candles that have a narrow range, we'll see that it has low volume. For instance, take the example of this narrower bearish candle in the same price vector. It has a narrower price range and a higher volume than our candle in question. In that perspective, this wide range candle has a low volume relatively speaking, so it can be classified as a wide range low volume candle, which is the same as a low volume reversal candle, and indeed price reverses right after it. In the same price chart, we can spot an example of a low volume rest candle, which is simply the combination of narrow range with low volume. We know this is a narrow range with low volume by comparing it with other candles in the chart. We have a resistance line defined by an important high in the chart. When the candlestick in question touches and reacts to it with narrow range and low volume, we have an indication that buyers are not trying to push past that resistance with enough power. In other words, we can trust this resistance line a little bit more because there is not too much interest in breaking it. Beyond that, look how the candlestick closes on its lower range after touching the resistance. That's an indication that we have some sellers in that line. In this other chart, we can spot a high volume continuation candle, which is simply the combination of wide range with high volume. This candle lands exactly at a resistance line. So the question that emerges is whether the resistance will be powerful enough to hold the high volume. Notice also how this candle is much wider than all the previous candles and how it shows a spike in volume, which is perhaps twice the volume of a normal candle. We can see that in the next few candles, sellers at their resistance attempt to hold these powerful buyers, but as soon as the sellers meet the point from which buyers ignited, an even wider bullish candle with a much greater volume spike emerges, therefore confirming the appearance of the high volume continuation candle before the resistance was broken. Volume spread analysis allows you to read the subtle clues in volume in order to anticipate important price movements. In this next chart, you can see an example of a high volume reversal candle, which is simply the combination of narrow range with high volume. We can know this has narrow range and high volume by comparing it with the previous candle in this case. The previous candle has a wider range and a lower volume than the candle we are analyzing. The most important detail here is that when a candle has narrow range and a high volume, it means that one side of the market is trying to aggressively advance and the other is successfully absorbing the attack. In this situation, we see sellers attacking aggressively, but buyers are being successful at absorbing the attack, which creates a lot of volume in a narrow price range. The result is a narrow range candle with high volume. Observe also how this creates a natural support level at the low of the candle in question. Once price returns to it a few candles later, we see those powerful buyers begin a new upward price movement. Notice an interesting detail about narrow range candles. Both the high volume and low volume versions of narrow range candles can mean a reversal, but for different reasons. This is called volume ambiguity. A narrow range candle with low volume means there is lack of interest in the current side of the market, which can mean a reversal in the near future. A narrow range candle with a high volume means there is a successful absorption from the opposite market player, and therefore the market is not able to advance to the current side anymore, which is also an indication of a possible reversal in the near future. These are just a few examples of volume spread analysis in real market scenarios, but there is a whole spectrum of how these things play out in real charts. However, the goal of this course is to introduce the basics of volume spread analysis. That's it for this video. I hope you were able to learn something new. If you want to learn how to trade with professional tools, please check out my premium courses in the video description. If you enjoyed the material I produce for free in the channel, please help support it by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. If you made it this far in the video, congratulations and thank you very much for watching. I hope to see you in the next videos. Take care.